index fund is a type of investment fund that tries to match the performance of a certain financial market index, like the S&P 500. Most of the time, these funds have low management fees and are considered passive investments because they just follow the performance of an index instead of trying to beat it. Index funds are often seen as a low-cost and diverse way to invest in the stock market, making them a popular choice for long-term investors. There are several advantages to investing in index funds, including: first, low cost. Index funds typically have lower management fees than actively managed funds, which means more of an investor's returns comes from underlying investments in the fund. Second, diversification. Index funds give investors exposure to a wide range of companies and industries, helping to spread risk and reduce the impact of any individual stock performing poorly. Third, consistent performance. Index funds have been shown to perform similarly to actively managed funds over the long term, despite the lower costs. Fourth, easy to understand. Index funds are simple to understand and require less research than picking individual stocks, which makes them a good choice for beginner investors. Fifth, tax efficient. Index funds tend to have a lower turnover than actively managed funds, which can lead to lower capital gains taxes. Sixth, professional management. An index fund is professionally managed by experienced managers who monitor the fund and make sure it stays online with the index it's tracking. Seventh, access to a wide range of markets. Index funds give investors access to a wide range of markets and sectors, including international markets, which can be hard for individual investors to get into. Eighth, lower risk. Index funds are considered to be less risky than actively managed funds or individual stock picking because it is based on the performance of a broader market index. When we first heard about index fund investing, we hardly understood anything. It was almost like learning a new language, but we continued to research and learn more about it until we were able to grasp the topic. In today's video, we think that it is about time to make a video about it and feed your mind with new discoveries. We can always think of index funds as emergency backup plans. Businesses have their own shares of fame and failure, and if our businesses weren't successful, we would have become millionaires anyway through these types of investments. Also, don't forget to like and subscribe to our content. Part 1. The lies. You have been at a major disadvantage, and people have been telling you lies about investing all your life. For instance, do you remember growing up at school where your teachers would always tell you that investing was only for the rich, as they can always afford to hire professionals to do it? For the longest time, we believed that investing wasn't for us at all, since we weren't professionals, and we didn't have a lot of money. We thought we didn't have a chance. We've been told to read every financial newspaper and website and learn to read charts, and then according to others, we have been told that it is a waste of time. And on top of this, if we mention the word investing to family, they often seem frightened because they think of it as the riskiest thing in the world, and it is not normal for people. These lies are exactly what the experts want us to believe, as they know that index fund investing is extremely easy to do. We don't need much money to start, and the risk is pretty low and average. It'll make us money in the long run. The harsh truth is that the average actively managed funds earns only 2% more than the market as a whole. This means that professionals are doing worse on average than index funds. And even if they end up losing your money, they will still charge you fees no matter what. Part 2. The game. We knew that when we started investing, we were going to make a lot of mistakes. But this way of investing will make it easier and less prone to mistakes. So in this video, we've been discussing index fund investing, and we think it's about time to explain it to you. Some of us are football fans, and if you have followed any sport, you'll be familiar with the league table. The better your team performs, the higher they will be on the list. But on the other hand, they might be removed from the entire league entirely if they do badly. This is similar to an index fund investment. All you have to do is switch out the teams for companies. For example, on the list of the 500 best performing public companies in America, Amazon, Google, Apple, and more recently Tesla are the major players. Just like a league table, if the companies are not performing well, they are at risk of being removed from the list. The idea of an index fund is to be a little sneaky, as it allows us to invest in every single company on the list with just one click. Investing in index funds means that even if a few companies do terribly, they will be balanced out by companies that are performing well. The average return on the S&P 500 over the last 10 years has been 13.6%. That is higher than usual. But get this, no one has ever lost money if they bought and held on S&P 500 index fund for more than 20 years. If this is foolproof, then why do people still buy individual stocks? We are also thinking that some companies are currently working on awesome technology for the future, but they're not making a lot of money at the moment. So they might not make the cut into the popular index funds. The terms Roth IRA in the United States of America for stocks and shares, ISA in the United Kingdom, TFSA in Canada, and supers in Australia are frequently used. But what does it all mean? These are the types of accounts that allow us to earn profits on your investments, and we don't have to pay taxes on them. They generally have limits because of how powerful they are, and they are kind of like Captain America's shield. I will explain why. If Captain America just stayed at home with his shield, he wouldn't get anything done. But when he takes his shield into battle, there is an advantage. These accounts are like your shield, so make sure we continue to use them when investing. A way we can do this is by using the money inside your shielded account to invest in index funds. And all the profit will be yours because the government won't take a cut. One of the biggest questions we had when we first started was, should we invest all of our money at the same time or do it gradually? This is something investors argue about, and we will be giving our view on it. For example, if we are going to invest this $10,000 in full, it kind of gives you the idea that investing all your money in one lump sum is certainly more risky. However, if we are investing in something we know will increase over time, like an S&P 500 index fund, then there's no point in waiting. The longer you wait, the worse off you will be. But if you do not have any cash, we shouldn't wait to save up the money. We can invest in what we have every month. Sometimes we are going to buy at a higher price, and other times you are going to buy at a lower price. Overall, this is going to be balanced out, and this is known as dollar cost averaging. When you log into an investing website or app, we will see that there is something called ETFs, which are very familiar to index funds, and some people get them confused. Both index funds and ETFs allow us to invest in a basket of stocks. However, remembering the difference is as simple as remembering what ETF stands for. ETF is an abbreviation for Exchange Traded Fund. If we break that down simply, it just means that it can be traded in the stock market throughout the day. Whereas an index fund can be sold for a price that can be set at the end of each trading day. But let's cut to the chase. We probably want to know which one is better. On average, if we are starting with a small amount of money, then ETFs may be a better option, as they have lower minimum investment thresholds and many brokers don't charge a trading commission. Now, if you are still watching this and you are younger than 18, then we are impressed that you have been listening to us for so long. Not many learn about this at such a young age, and they don't teach it at school. But why not? When you can start investing at the age of 18 and open a custodial account in America, or set up a junior stocks and shares ISA in the United Kingdom. To set these up, we just need to ask your parents. The real secret ingredient to this millionaire formula is time. When we are younger, we have so much of it. That's because every year, as we keep adding to your investments, the interest starts to compound and grow at a rapid pace. It's a snowball effect. Once we reach a certain tipping point, the interest we are earning is much higher than the amount we are investing on a monthly basis. It's similar to seeing a content creator take a long time to reach 100,000 subscribers, only to surpass the million mark in a matter of months. The sooner we get started, the better, as time will be on your side. Now we want to clarify something. When people talk about index funds, we will often hear S&P 500 again and again. As we mentioned before, the S&P 500 represents the top 500 companies in America. The coolest thing that we need to know is that we don't have to be in the United States to invest in this. We can be in any part of the world and feel like we own a small portion of the stocks of the biggest companies in America. Part 3. The strategy. Many people will teach us what we should do, but not how we should do it. We are going to walk you through everything right now. The first thing we should do is work out our goals. Let's say that we want to become millionaires. That is a common goal for most people. So we just have to work out how much we need to invest per month to achieve this. We love using compound interest calculators, and we can find them easily online if you want to give them a try. If we are able to invest $250 per month with an $8 annual return over 42 years, you will have over $1 million in your account. And if we are able to invest that in the next 10 years, we'll have over $2 million in your account. And if we also want to invest more, we are going to speed up the whole process. The next thing we want to do is pick the brokerage website we are using to set up an account and invest. Charles Schwab, Fidelity, and Vanguard are some options. We call this the Big Three. John Bogle, who started Vanguard, is often called the father of index fund investing. His Vanguard group gave birth to index funds, and they're the oldest and most trusted. Let's check out their website and see what they have to offer. To get into their list of funds, just go to the Vanguard website, go to Investing, and click on Vanguard Mutual Funds. The page can look extremely overwhelming, but in a minute, we'll be able to impress all your friends when we know exactly how to read it. There are just so many options, and the main thing is to focus on the expense ratio, which is how they are going to charge us for a year. We probably want to keep this as low as possible, and luckily, Vanguard's fees are relatively low. The other thing to look at is the average return, which they can break down nicely on the right-hand side of the screen. It is always good to remember that past performance doesn't always mean future returns. The funds are arranged in different categories, and everything is easy to find. Category 1. Bonds. These are a type of contract that companies and the government sell when they need extra money. If we invest in these, they promise to pay us back in the future. These are often pretty low-risk investments, but they also have low returns. The older you are, the more bonds we should have in our portfolio. There are several advantages to investing in bonds. Stability. Bonds are thought to be a fairly stable investment because the interest rate and date of maturity are set. This can provide a predictable stream of income for investors. Diversification. Bonds are a good way to add variety to an investment portfolio because they tend to do better than stocks when the economy is bad. Risk management. Bonds are less risky than stocks. They can be used to help manage overall portfolio risks. Lower volatility. Bonds tend to be less volatile than stocks, meaning that the value of a bond investment is less likely to fluctuate dramatically. Preservation of capital. Bonds are generally considered to be a safer form of investment. They tend to hold their value and provide a consistent return over time. Tax advantages. Depending on the bond and the investor's tax situation, the interest earned on bonds may be eligible for preferential treatment. Inflation protection. Bonds can be a good way to protect against inflation, as the fixed interest rate paid on bonds will rise with inflation over time. The idea behind this is to pick an age which you can wish to retire, and they'll do the work for us by finding the right index funds. These go up in 5-year intervals, and we can pick whichever suits your plans best. This could be a good option if we wanted to invest without thinking too much about it, but we will always prefer manually investing. The experience is similar to driving an automatic car that does all the work for you. It is not as fun as a stick shift. Category 2. Company and size. An alternative name for this is a small, medium, or large cap. The VFIAX, which tracks the S&P 500, is located here. This indicates that the fund has been chosen and is advised by Vanguard. If we click on it, we can see exactly which businesses we would be investing in as well as the level of risk. Another excellent option is the Total Stock Market Index Fund, which holds over 3,586 different stocks. With just one click, we can now invest in the entire US stock market. There's also an ETF version with no minimum called VTI. Then we have international stocks, which invest in companies based in China, Taiwan, India, and many more. But as you will see, this can be on the high end of the risk scale. Category 3. Sector-based. What if we had a particular interest in energy, healthcare, or real estate? We can invest in these sectors. There are a myriad of options for sector investing in the ETF. Now, we have finally broken down what they can offer. The funds that are available in every country are similar, but the index fund that they are tracking down is different. Obviously, we can still use the percentages as a guide. 70% of individuals invested in the biggest economy in the world, and that is the United States of America. We like to balance this out by investing in a different economy. We can look at your own country and invest $2,000 in, say, FTSE 100 index fund. We can invest 90% and place the remaining cash into a global bond index. Just like that, we have then invested in American companies and also own a small portion of stock in the United Kingdom. There are several potential benefits to sector-based investing, including: first, focused investment. By investing in a specific sector, investors can target companies they believe have the most growth potential, potentially generating higher returns. Second, diversification. Investing in a sector can provide diversification within the portfolio, reducing risk by spreading investments across different companies and industries. Third, alignment with personal values. Investing in a specific sector can also align with an investor's personal values, such as investing in a company that operates in the renewable energy sector, if an investor is concerned with climate change. Fourth, industry-specific knowledge. Investing in a sector that an investor has knowledge or experience in can help them make more informed investment decisions. Fifth, better understanding of the market. By focusing on one specific sector, investors can get a better understanding of the market trends and the companies within the sector. Don't forget to subscribe to our channel and stay tuned for more of our videos on personal finance and much more. Click that notification bell icon if you want your riches to grow bigger than ever before. And we will see you all in the next video.